Welcome to the deep dive. Okay, so there's this really powerful three-digit number, and it pretty much dictates huge parts of your financial life. Things like your mortgage rate or even just getting approved for that apartment you want. We're talking about your credit score.
Yeah, it's basically the ultimate measure of, well, financial trust, isn't it? But for a lot of people, figuring out how to actually improve it feels, well, kind of mysterious. So today we're going to cut through that mystery. We've looked at the sources, and we're aiming to give you a clear strategic roadmap. We're not just defining the score, we're breaking down exactly where you should focus your effort, for the best results fast.
That's absolutely the key. People know the score exists, right? Usually somewhere between 300 and 850. But they often think improving it is some kind of magic trick. It's not. Our research really confirms it's just math, basically, applied with patience and consistency. You need to know which levers actually move the needle. Okay, let's unpack this then. Our mission today is to get past the basic definitions and really focus on the strategic weights. Because I think the key insight right from the start is that the five factors making up your score, they're definitely not created equal.
Exactly right. When you actually look at the breakdown, the priorities become super clear. There are two factors that just dominate everything. They account for almost two-thirds of your entire score.
Two-thirds. Wow. Okay, so what are these two financial heavyweights?
Well, number one, the absolute foundation, payment history. That makes up a huge 35% of your total score. And then right behind it, taking up most of the rest of that big chunk, is credit utilization. That's another 30%.
Hold on, 35 plus 30. So yeah, 65% of your score just boils down to two things: paying your bills on time and how much debt you're carrying compared to your limits. That implies if you just fix those two areas, the impact could be, well, pretty immediate and significant.
It really is. The other 35%, that's split between length of credit history, that's 15%, then credit mix at 10%, and finally new credit inquiries, also 10%. But yeah, the smart strategy has to start with that big 65% chunk.
Okay, let's dive right into the biggest one then. Payment history, that 35%. We all kind of know missing a payment is bad, but the sources suggest the penalty isn't just bad, it's actually catastrophic.
Oh, it's dramatic. Seriously.
Yeah.
Depending on where your score was to begin with, just one payment reported as 30 days late, that can easily knock your score down anywhere from, say, 50 to over 100 points instantly. It is, without doubt, the quickest way to just demolish months, maybe even years, of building up good habits.
Okay, but what if someone listening already has a few dings in their past? Does that 35% weight mean they're just stuck with that penalty forever?
No, not at all. But this is exactly where that consistency piece comes in. Lenders care less about a mistake you made 5 years ago compared to one 5 months ago. Time really does heal wounds in the credit world. The longer you show perfect on-time payments, the less impact that old negative mark has. So the advice is set up automatic payments for everything, not just credit cards, but loans, utilities, your phone bill, anything that might report. Make it automatic, make it non-negotiable.
Right, take the forgetfulness factor out of it. Okay, that brings us neatly to the second giant piece, credit utilization, the 30% factor. We know it's about how much of your available credit you're actually using, but is there a magic number we should be aiming for?
Well, the standard advice you usually hear is keep it under 30%, and that's okay. But honestly, if you really want to push into that excellent score range, our sources point to a much tighter target. Try to aim for 10%. So let's say your total credit limits across all cards add up to $20,000. Ideally, you never want your reported balance to be more than $2,000 because lenders see high utilization as high risk. It doesn't matter if you plan to pay the bill in full later. High usage looks risky now.
Okay, this leads to one of those really interesting kind of non-obvious tips, and I want you to explain the why behind this. We're telling people they should try paying off their balance before the statement closing date, not just waiting for the payment due date. Why does that specific timing make such a difference?
Ah, yes. It's because the credit bureaus get their data based on your statement closing date, not your payment due date. That closing date. That's when the bank takes a snapshot of your account balance for the month. So if you charge, say, $4,000 on a card with a $5,000 limit, but you wait until the due date, which might be 3 weeks after the statement closes, to pay it off, well, the Bureau has already seen and recorded that you are using 80% of your limit for that period.
80%. Wow. Okay, so even if I pay it off completely by the due date, my score could still take a temporary hit for those few weeks just because of when they took that snapshot.
Precisely. But think about this. If you pay off, say, $3,500 of that $4,000 before the statement closes, then the bank only reports a $500 balance. Suddenly, your utilization is down at 10%, and boom, your score reflects that responsible behavior almost immediately. That's pure strategy, just understanding the reporting cycle.
That's a fantastic point. Pure strategy indeed. Okay, great. Now let's move on to the supporting pillars. That last 35% of the score. This is where time, variety, and patience come in.
Right, so the next biggest slice here is length of credit history. That's worth 15%. And this is all about the average age of your accounts, how old your oldest account is, and the average age of all of them together.
Okay, and here's where I think some old, maybe outdated financial advice can actually hurt people. You often hear people say you should close old credit cards you don't use anymore. Why is that usually a mistake based on what we're seeing?
It's a mistake because closing that old account instantly shrinks two really important metrics for your score. First, like you said, it lowers the average age of your accounts. That directly hits that 15% history factor. But second, and maybe even more importantly, it reduces your total available credit, which means your utilization ratio, that 30% factor we just talked about, instantly jumps higher, even if you haven't spent an extra dime.
Ah, okay. So the strategy is simple then. Unless that old card has a crazy high annual fee or something, just keep it open. Maybe even, like you suggested for payment history, put a small recurring charge on it, Netflix maybe, and set it to auto pay the full balance each month just to keep it active and positive.
Absolutely, that's a perfect way to handle it. Now, moving on to credit mix, which is the next 10% component.
Yeah.
Lenders like to see that you can handle different types of credit responsibly, not just credit cards, which are what we call revolving debt. They also want proof you can manage installment debt.
Installment debt, like a car loan, student loan, or a mortgage, right? Fixed payments over a set time.
Exactly. It shows you can make a consistent payment commitment over a fixed term. So if someone listening only has credit cards, they might actually benefit from adding some kind of installment loan to their mix. This is actually one reason why things like credit builder loans can be so useful, especially for people starting out.
Right, it demonstrates that other kind of credit management. Okay, and that takes us to the final 10%. New credit inquiries. This is where people sometimes get a bit anxious about hard checks or hard pulls. Let's say I'm shopping for a mortgage or a car loan. I might apply to, I don't know, 5 different lenders in a week to compare rates. Does that string of hard inquiries just trash my score?
That's a really common concern, and it's a great question. There's actually a crucial exception built into the scoring models for this exact scenario. While yes, single applications for new credit, like applying for a new store card just for the discount, those should probably be spaced out maybe 6 months apart or more because each one can cause a small temporary dip. But inquiries for rate shopping on mortgages, auto loans, or even student loans, they're usually bundled together.
Bundled? How does that work?
The scoring models are smart enough to recognize you're shopping for the best rate on one single loan, not trying to open 5 different loans at once. So they'll typically treat all inquiries for the same type of loan within a specific window, usually something like 14 to 45 days, as just one single hard inquiry. This stops you from being penalized for doing the financially smart thing, which is shopping around.
Okay, that's a huge relief. Good to know. And just to be super clear for everyone listening, checking your own score using a free service like Credit Karma or maybe through your bank, or getting pre-approved for offers online, or having an employer do a background check for a job, those are soft checks, right? They don't hurt your score at all.
Correct. Zero impact on your score from those soft inquiries. Feel free to check your own score regularly. Now, speaking of building scores, especially for listeners who might be starting from scratch or need a pretty significant boost, we should talk about some specific tools that can generate positive data relatively quickly.
Yeah, good idea. We touched on the credit builder loan already, which is great because, like you said, it mimics an installment loan. You're essentially saving money while building a positive payment history. It's kind of a win-win.
Exactly. And the twin tool for revolving credit is the secured credit card. This is often the perfect entry point for building credit. How it works is you deposit your own money with the bank, let's say $300 or $500, and that amount becomes your credit limit. Then you use that card just like a regular credit card, making small purchases and, crucially, paying them off on time and keeping that utilization low. The bank reports all that positive activity to the credit bureaus. After maybe 6 to 12 months of responsible use, you've established that positive payment history, shown your low risk, and often the bank will then graduate you to a standard unsecured card and give you your deposit back.
That sounds like a really solid path for building trust with the system. But sometimes the fastest way to a higher score isn't about building new history. Sometimes it's about fixing old mistakes or even correcting errors that weren't yours in the first place. We need to talk about being proactive troubleshooters with your credit report.
Yes, absolutely essential. By law, you are entitled to get a free copy of your credit report every single year from each of the three major bureaus, Equifax, Experian, and TransUnion. You must review these reports carefully. Errors are surprisingly common. Things like payments mistakenly reported as late, accounts listed with the wrong balance, or sometimes even signs of identity theft with accounts you never opened.
And if you do find a genuine error, what's the process? How long does it take to fix? And what kind of score bump could you potentially see?
Well, the Fair Credit Reporting Act, the FCRA, mandates that the credit bureaus have to investigate any dispute you file, assuming it's legitimate. They then have to correct any verified mistakes, usually within about 30 days, and the impact. Because you're essentially erasing a negative mark, which, remember, hits that huge 35% payment history factor. A single correction can often boost a score that's been stuck. We're talking dozens of points, sometimes almost overnight. It's frequently the single biggest quick win you can find if there's an error on your report.
Okay, dozens of points is significant. Speaking of potentially quick wins, let's talk about the authorized user strategy. Now, I know some people feel like this is kind of gaming the system, but our sources indicate it's a totally legitimate way to, well, leverage someone else's good credit history almost instantly. Can you explain how that works and, importantly, what the potential downsides are?
Sure. So it works by essentially linking your credit file to the file of the primary cardholder. You ask someone you trust implicitly, someone with a long, excellent credit history and consistently low credit utilization, to add you as an authorized user to one of their well-established credit cards. Usually an older one is best. You don't even need to get or use the physical card yourself. The credit scoring models see that card's entire positive history, all those years of on-time payments, the low debt ratio, the age of the account, and they effectively graft it onto your credit report. This can provide a really significant boost, especially for people who have a thin file, meaning not much credit history of their own.
Okay, but I have to push back a little here. If I'm benefiting from their good history, doesn't that mean I'm also exposed if their situation changes? Like, what if they suddenly run into trouble and start missing payments on that card? Does that come back and bite me?
Absolutely. And that is the critical risk, 100%. You are sharing their credit history on that specific account, for better and for worse. You must only do this with someone you have complete trust in, someone you know is meticulous about their finances. Because if they do miss a payment or run up a huge balance, that negative information will appear on your credit report too, potentially dragging your score down significantly. It's definitely a shared risk, not some kind of free lunch.
Right, that makes sense. Trust and communication are obviously key there. Okay, so circling back to managing your own finances and maximizing your score, to summarize the sort of highest level of strategy for listeners, particularly if they're carrying some debt across multiple cards, where should they focus their payoff efforts first for the biggest score impact?
Right. Strategically, you always want to attack the highest utilization first. Remember that 30% factor is incredibly powerful. So paying down the balance on the card where your current debt is closest to the credit limit, the one with the highest debt-to-limit ratio, that will generally give you the fastest score increase.
And interestingly, the cards with the highest utilization ratios are often also the ones charging the highest interest rates, right? Like store cards sometimes. So by focusing on paying down that highest utilization card first, you're not only maximizing your potential score improvement, but you're usually also saving the most money on interest payments at the same time. It really is a win-win.
It's definitely the most efficient and financially sound approach, yeah.
Yeah.
It tackles both issues at once. And, it's important to remember that building or rebuilding your credit score, it really is more of a marathon than a sprint.
Yeah.
But the impact of making these kinds of strategic changes, you can often see positive movement faster than you might think. You should generally start seeing some positive trends within, say, 3 to 6 months. And real commitment over a full year, consistently applying these strategies, that can lead to really significant, lasting improvement.
Okay, and maybe one final practical step for people. How should they keep tabs on their progress without driving themselves crazy?
Yeah, definitely don't check it daily. That just creates anxiety. Use one of the many free apps out there, or maybe a feature your bank offers. Check it about once a month. That gives you a good sense of the trend line. Now, if you do see a sudden, sharp drop, like more than 10 or 15 points out of the blue, that's your cue. That's when you immediately pull your full credit report and look for potential errors or maybe a payment you missed without realizing it. Catching those issues fast is key to minimizing any long-term damage.
Great advice. Monthly check-ins, investigate big drops.
So when you boil it all down, what does this really mean for you, the listener? strong credit score. It's less about proving you're rich and much, much more about proving you're responsible. Every single smart decision we've discussed today, timing your payments right, keeping old accounts open wisely, strategically paying down utilization, each one builds trust. It builds trust with the entire financial system. And that trust, it's actually quantifiable in your score. And every point you gain genuinely opens new doors financially, helping you secure better loan rates, better insurance premiums, saving you potentially thousands and thousands of dollars over your lifetime.